My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramer. Other people make friends. I'm just trying to save you some money. My job's not just to entertain you, but to educate and teach you. So call me, 1-800-743-CNBC. Tweet me at Jim Cramer. Today certainly started out as a sedate kind of day, and it looked like we were going to have still one more placid move higher. But as the afternoon wore on, sellers swarmed in. Perhaps because this is one of the most overbought tapes in ages. And it's nuts not to take a few profits here after this kind of multi-week run. By the end of the day, we had a serious and total rout.
The house of pain.
On our hands with the Dow tumbling 476 points, S&P plunging 1.47%, NASDAQ plummeting 1.5%. Sell. It was one of the ugliest days in months, and all I can say is what I've been saying to the investing club and to you in the morning, noon, and night. You have to take like days like this, and you have to do some selling. Just like we've been doing for the Travel Trust. These are days to get out, not to get in. You have to take something off the table. It's been too good for too long, and too much buying and not enough selling, and now it's time to pay the piper. I know, even though most of the damage stemmed from a not-so-hot quarter from FedEx, which just got pancaked, falling almost $34, 12%, there was a ton of finger-pointing at, well, let's say the usual suspects, the Magnificent Seven. Me, I thought that was the wrong place to find woe. In fact, it was one of the places to find a glimmer of hope, and that was the trading in Alphabet, formerly Google. So rather than dwell on the sell-off, which everybody's doing, maybe, and it probably isn't even finished, by the way, I want to talk about resilience, Mag 7 style of this crazy stock market. Do you know, at one point today, Alphabet stock, which closed up $1.69, had rallied $5, adding nearly $63 billion in market capitalization. And I searched all over the reason why some stock was up that much. Hey, look, a stock that moves up more than $60 billion is a stock that you got to pay some attention to. I looked around and saw some stories, the most cogent being that the company might be reorganizing its gigantic ad sales force now that it can use machine learning to figure out what works best. Who needs 30,000 salespeople in an ad sales unit when artificial intelligence can figure out the smartest way for your customers to advertise? Hey, that makes sense. We know Adobe's artificial intelligence platform can tell us what the right colors to use on an ad and what words are action-oriented. So why can't Alphabet do the same thing with its treasure trove of search data? Who needs so many marketing experts with subjective opinions when we now have machines that can simply tell you the right answers? And those machines, they don't get paid. They don't take vacations. They never have a sick day. They're never in a bad mood. You don't need to cover them with health insurance. You don't have to take them to a Christmas party either. Not long after Alphabet's big jump, Steve will put out a note explaining that an ad department restructuring could be worth anywhere from 8 to 20 cents per share. Or suddenly we have numbers. Struck up a pen. 8 to 20 cents. How many companies can lay off a ton of people and see their earnings jump? Not just because people are expensive, but because the machines can do a better job. This one did get me thinking, though. This is one of those reasons that the Magnificent Seven has been so magnificent, so unbeatable. At any given time, especially on a down day like today, some jokers can find an idea that might be worth more than $60 billion from one of these companies. For example, when I saw that Alphabet was up that much, I immediately thought of a half dozen other ways they could have created value. Let me walk you through them. First, I wonder if they could finally get rid of Waymo, their self-driving business with great technology that Alphabet simply hasn't been able to monetize. When you think about it, GM blew $8 billion on its self-driving business, only to say goodbye to all the senior managers, including Kyle Vogt. I rode around with him in self-driving cruise in San Francisco not that long ago. That might not be the best comparison for Waymo, but self-driving is not exactly a home run. Maybe people just, in the end, like hands-free driving. Maybe there'll always be resistance. Maybe Alphabet should just sell Waymo to GM or whoever's willing to pay something for it. That might make the stock go up a ton. Although $63 billion is a lot of money. That might be a stretch. Waymo's got a real following in San Francisco, and it's moving into Austin. What a great time to spin or sell it. Second, Alphabet could easily rally that much if they decide to spin off Google Cloud Services as a separate company. Last quarter, this division did around $8.6 billion in revenue, disappointing the bulls. hoping for $8.5 billion. Yeah, I mean, really, even though we're only talking about a less than a $200 million difference here, the stock shed $180 billion in value in response to this one division. $180 billion. Heck, if they closed down Google Cloud, it might not have been down that much. Can you imagine how great it would be if Alphabet spun this business off in a separate company and kept back 25%? Third, last time Google reported, they talked about how the beloved their Sunday NFL ticket was, but they didn't give us any numbers. If we simply hear rumors that they're telling people those numbers are incredible, much higher than expected, then the stock's going to roar. Fourth, if we hear that YouTube Shorts have jumped from 70 billion views to 100 billion views, and thanks to the AI-powered advertising, they're generating a lot more revenue, maybe double what they used to. Well, that might sound crazily optimistic, but I think it's within the realm of possibility. You get $100 billion increase in the stock. Fifth, if Alphabet settles all cases with every entity that's suing them or even thinking of suing them, and the settlements only amount to a couple $1 billion, well, let's see, they can tell the Justice Department, here's $1 billion. The FTC, here's $1 billion. In the States, you get $1 billion. In Europe, you get $1 billion. Hey, full Oprah mode. Next thing you know, the litigation risk is gone, the stock's on fire. Or six, they could do the opposite. Let's say Alphabet throws in the towel, gives the antitrust regulators exactly what they want by breaking up the company, splitting into Search and Waymo and hardware and software and Gemini and Deep whatever, YouTube, Cloud, Highmark Health. I mean, the grab bag, other bets. Boy, there's a lot here. If you break them into separate companies, I think they collectively worth much more than $160 per share. Not bad for $138 stock. Granted, some of these are, let's say, pretty out there. But you know what's the craziest thing? I could literally create a list like this for every one of the Magnificent Seven except NVIDIA, which is pretty much a straightforward graphics card company. The other six are so vast with so many divisions and so many moving parts that if they decided to split up or trim a losing division or sell something extraneous, it could propel their stocks up $42 billion, $50, $60 billion in a blink of an eye. Now, today was a crummy day in the market. We were due for a pullback. We were way overbought. These stocks have been up for what it seems like forever. As we have many others, besides just the Magnificent Seven going higher. But unlike the others, the seven, or at least six of them, actually can control their own destinies, at least over short periods of time. Is it fair that with a wave of an 8-cent won, Alphabet stock could rally $5 this morning? Of course not. But this is the problem we have we have thousands of stocks that are worth less than $50 billion and only a handful that are worth more than $500 billion. The mega cap companies always have some business that people don't like. If Mark Zuckerberg, for example, came out today and said he was closing his metaverse division, I can't even imagine how high Meta stock would go. I don't even know if you can open it. If Amazon decided that it would spin off Alexa, not that I want that, this stock would soar. In the end, each of these now hated divisions might turn out to be amazing stuff. Long term, maybe it's a mistake to spin them off. But the bottom line, when you look at the landscape of stocks in the red today, you should be thinking about one thing. The Magnificent Seven have the most optionality of any publicly traded companies in modern history. To sell any of them is to forget that they have this kind of incredible power. Let's go to Jim in New York. Jim.
Booyah, Jim. First-time caller.
Glad to
I have
you.
I have a $10,000 gain in Pioneer Natural Resources.
Okay.
Should I sell, or should I wait till ExxonMobil take over and then take the stock?
No. Just sell it. I mean, we're oil's in an uncertain position. I want you to take the gain. That would be terrific, and I say congratulations. How about we go to Raj in New Jersey? Raj.
Hey, Jim. Booyah.
Booyah, Raj. What's up?
I enjoy your program, and I am a member, and I have an all-access membership with CNBC.
Excellent.
And I enjoy your text messages and objective coverage.
Thank you.
It has been a wonderful experience. Congratulations.
Oh, man, thank you.
And my question is about the NVIDIA. It has been going up and up and up, and today there has been a pullback. Should I continue holding with
Yes, NVIDIA is stalled right here. NVIDIA had the biggest blowout in the history of the Western world, and then had another good blowout, but it wasn't enough, and the stock's been meandering, and a lot of people are getting tired of it, and they're probably going to sell it down or say it can't reach a double top or something like that. Micron reported a good number tonight, not really analogous. But I think NVIDIA is one amazing company, sells at 25 times next year's earnings and 20 times the year after that. That's too inexpensive versus the tremendous growth you have. Peter in Pennsylvania. Peter.
Hey, booyah, Jim.
Booyah, Peter.
Hey, I love your show. First-time caller. And I love the advice on NVIDIA. My question is, I bought this stock about a year ago, paid about $50 a share, bought some more on the way down. Now it's at 28. Buy, sell, or hold Pfizer, PFE.
Oh, Pfizer. Okay, well, here's the problem with Pfizer. They just don't have a good enough pipeline. I think the stock with the 6% yield is fine. But you know what? If it's at $27 and it went to 32, here's what I would tell you to do. Sell. Yeah, I wish I could be more positive, but that's really about it. I don't think there's much more to it. All right, amid the landscape of red in the market today, it's worth remembering the Magnificent Seven have the most optionality of any publicly traded companies in modern history. To sell any of them, you must remember that they can always do something that helps their cause. On Man Tonight, the win streak for the Dow and NASDAQ may indeed be over. I'm eyeing one name in tech that's recently caught fire that you may have missed that might be worth buying into the weakness. Then FedEx is falling with the rest of the market, down 12% after a second quarter miss. What could it mean for the delivery giant going forward? I'm taking a closer look. But first, this week we hosted our monthly meeting for CNBC Investing Club subscribers, and we couldn't get to all of your amazing questions. So we decided to keep the momentum going and give them you today. Question and answer, and I think you'll like them. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.